How's it going, everybody? I hope you're all having a good day today. The markets have been going crazy recently. We have pretty much everyone on Wall Street. They're all scared of AI. They don't want to invest into SaaS. They don't want to invest into the companies building out the AI. So they're just pivoting from, you know, the best business models in the world over to the Walmarts and the Costco's and the waste managements and to utilities and defensives and all this stuff. So there's some really great buying opportunities out in the market that I'm seeing today. So I thought today would be a great day to post a video going over a few companies that I think you should definitely check out. Before we get into that, I kind of want to just hop over here. This is a tweet I posted last night, kind of showing the fear that I'm seeing. I was listening to the Toast conference call. The tweet says, listening to the Q&A section of our earnings report for the past three quarters is just listening to management getting asked multiple times about the impact of AI on their business. They almost always say it's a tailwind, and then the next quarter they ask the same exact question. Just experienced this in the Toast call as I've basically in every 10 or so calls that I've listened to this quarter. And here I quote tweeted it shortly after. I took 4 different snippets from the Toast conference call. They answered, I believe, 6 or maybe 7 questions throughout the whole conference call, and 4 of them had the word AI in it, and you could just tell from the tone of their voice that they were seriously fearful about AI. I'm not going to read all of these, but all 4 of these, the fear is reaching the max. I believe I've never seen anything like this since I joined the market in 2021. It's a true fear of AI for anything software related. Toast isn't even like a pure software company. It has aspects of software, but I just thought that was very interesting. The first company I wanted to take a look at today is Intuit. I believe this is one of the highest quality compounding machines in the market, and it's now at a significant discount. As you can see, it traded up around $800 per share just last July, and now it's right around $400. It was under $400 this morning, so it's been chopped in half. Over the past 3 years, it's down 3%, while at the same time, we're seeing 13.5% revenue growth over the past 3 years per year. We're now at a price to free cash flow on a trailing basis of 17.5, close to 17, a PE at 27. This thing regularly trades up to the 40s. Just because it's such a sticky business, it's TurboTax, it's QuickBooks, and it's Credit Karma. 3 of my favorite business models, 3 different businesses all under one tree. 3 of my favorite business models in the world that I've personally researched. I obviously haven't looked at them all, but this is one of the stickiest ones. It's mostly recurring revenue. It's fast growth. As you can see here, this is just over the past 5 years or so. Everything is up and to the right. We have revenues growing at 21% annually. Free cash flow per share around 20% annually. And diluted EPS is around 18% annually. So there's no signs of slowing. There's no signs of disruption. It's just the market being unrealistic. They're very fearful right now. There's blood in the water, you can tell. So I think this is one you should definitely look into. Obviously, don't buy into anything if you don't believe in the moat and if you don't believe in the future of the company. But this is one that I truly believe in. I'm not going to do a full deep dive, but here's option number 1 for you guys. Stock number 2 I wanted to take a look at today is Adobe. Most of you know about this company. It is like the content creation software in the world. All your favorite movies, all your favorite TV shows, Super Bowl ads, TV commercials, advertisements, marketing, all that stuff is done through Adobe. Students are trained on it. Professionals are trained on it. It is the software. So as you can tell just from the share price over the past 3 years, 3 years it's down 30%, while we're looking at revenue growing 10% every year over the past 3 years. It's been chopped below, like less than in half from the highs. Highs are around 640-ish, 630, 640. And now it's trading at 260. We're going to need like 120% gain from this point to recapture those all-time highs, which I do believe we'll see someday in the future. Very healthy company, significant buybacks. The valuation is so low and the cash flow is so high that they're just chewing away at the outstanding shares. Here we have the same numbers pulled up for Adobe. I also pulled up the total shares outstanding just to kind of show you guys how many shares they're buying back. Over the past 5 years or so, they're buying back 3% of the company per year. It's actually accelerated. As you can see, yeah, if the closer we get to current day, yeah, over the past 6 quarters, they've bought back 5.5% of the shares per year. I believe it's even accelerated faster than that. Yeah, over the past 12 months, 6.5% of the shares outstanding are gone. While at the same time, you're looking at revenues growing over 10% every year, free cash flow per share growing around 14-15% per year, EPS around 15% per year. All of these are going to benefit from the shares going down. The valuation coming down is going to help the future returns as the company can buy back more shares. they're starting to take out debt to buy back more shares, leverage buybacks. So I believe in the mode of this company. A lot of people have questions around this one. The valuation on this one's much cheaper than Intuit even, but it is significantly lower than it was in the past. I believe that AI is going to be a tailwind for this company in the long run. Maybe, I honestly think the biggest competitor to Adobe is going to be Figma and Canva, which is they've already been fighting against for 5-10 years now. And they've been fighting off, and I don't believe that any of the top 70-80% of their revenues, which come from professionals and the biggest companies in the world, I don't believe that that's going to be under pressure from AI, as I don't see marketing teams rolling out AI slop, as well as I believe that we're just going to see a big surge in total content produced. So this is stock number 2 for you guys. Company number 3 we're going to be looking at here is Meta. Very popular. Everyone knows Meta. It's obviously not down near as much as Intuit or Adobe are over the past 3 years or even 1 year. As you can see, past 3 years is up 261%. But don't let that fool you. 3 years ago, I believe that, yeah, the company was significantly cheaper than today. It's still a great deal today, and it's a fast grower. We're seeing past 3 years revenue grow at 20%. It grew, I believe, 26% year over year in the past quarter, and they're guiding for 30%. So it's accelerating. They're spending a lot on CapEx, which is the fear, which is why we're seeing a sell-off. It was above 800, or right, it was close to $800. Yeah. For some reason, I thought it touched 800, but it was very close to $800. We had a big drop after earnings here. I started buying shares under 700. I bought some under 600. I think it's a great buying opportunity. We're looking at a 4 PE on one of the widest moat companies in the world. Half the world uses one of their apps daily. We're looking at a forward PE of 21, which is like market average. So they're pricing Meta, one of the fastest growing, widest moat companies in the world, as a market average company. It's a little more expensive on free cash flow, especially with the CapEx spend. Needless to say, I still believe this company has significant upside, especially for long-term holders. Here we have these same analytics for Meta. They're all three basically following each other almost to a T. We have revenues growing 17% on an annual basis. Free cash flow per share, 17% per year. EPS is a slight laggard, 16% per year. That was due to a one-time tax hit they took in Q3 last year. So it would also be right around 17-18% as well. But yeah, this is one of the fastest growing. They're expecting acceleration. I believe in the long term, the AI CapEx spend will significantly enhance the value of a Meta ad. And I believe this will further enhance their pricing power on ads. I think this is a great tailwind for the company. If it doesn't work out, they're going to have extra compute. They're going to be able to do something with it. And Jensen Huang, NVIDIA CEO, he said no one uses AI better than Meta. So I take that with more than a grain of salt. So if you're a long-term believer in Meta, I think this is a great one for you to check out as well. All right, fourth stock we're going to be looking at today is S&P Global. As you can see over here on the chart, steep decline. We were close to $550 a share earlier this year, January 13th. Now we're close to $400 per share. I believe it did go below 400. Yeah, 390. So people are seriously scared. They think AI is going to take over parts of their business, especially the market intelligence and the commodity insights part of the business. But S&P Global deals with about 95% proprietary data, so data that AI can physically not get access to unless given. And then they have other extremely wide moat parts of the business, including the rating agency, as well as the index business, which neither of those are going anywhere. I mean, it would take a significant change in our financial system for either of those to be torn down. Everyone knows about the S&P 500, and they are the company that made it. Anytime an index links to that or any of their other indexes, they get a cut. So, and even when the markets go up, they get an increased cut because it's a percentage of the total assets under management. So it's one of my favorite business models in the world. The rating agency, it's a duopoly with Moody's. They're basically a toll booth on all global debt, especially from governments and big corporations. And now we're getting it at a reasonable valuation. This one usually trades at sky-high valuations, but now we're looking at a trailing PE of 26, a forward PE under 20, but roughly 20. But you get the point. We're seeing revenues over the past 3 years, 11%, past 5 years, 15%. They're guiding a little weak this year. I think that has to do a lot with the spinoff of their mobility business, as well as the ratings are slow, but those are kind of cyclical. They will come through the toll booth, which is S&P Global's and Moody's. Eventually, they're a little choppy, but this company's going to grow at 10% plus revenue for 20 years, I believe, honestly, at least. one of the widest moat companies I can think of. It's a core holding of mine. I believe it has great upside. Here we have the same analytics for S&P Global. I added on the shares outstanding for this one because they're also a cannibal. This spike right here was because of a acquisition a couple years back. So let's take that out and see what we're looking like. As you can see, a steep decline. So this helps their per share metrics in free cash flow and earnings. As you can see, over the past couple years, they're buying back over 3% of the shares per year. Diluted EPS, it's rough for this time period, but like I said, it's kind of cyclical. We had a big spike in 2022 with the ratings. So, but over the long term, as you can see, let's go far back. Yeah, over the long term, EPS CAGR 30. So yeah, sort of a cyclical business, but I'm not too worried about exactly when revenues and free cash flows hit, as long as they come in the future, which they're guaranteed to with something like the ratings. Debt has to be rated. If you don't get it rated by S&P Global or Moody's, you're going to end up paying a lot more in the long run. Even if they were to give you a better rating, you're still going to pay more because no one wants to buy a debt from someone that isn't rated by S&P Global or Moody's or Fitch, which is a small player. They have about 10% market share. It's mainly S&P Global and Moody's. I think this is one you should definitely check out if you're looking for something really secure, really wide moat. And now after the sell-off, it has a lot less risk for multiple compression. I believe this is a great pick for long-term holders. All right, and here's my last pick of the day is Toast. A lot of you may know this company. You see it when you go to a small or mid-sized restaurant. You go to check out, you see the little Toast thing. I actually love this business model. It's very unique. I believe that they are going to grow an insane market share in small to mid-sized restaurants, and they're even expanding into things like drive-thrus and even bigger restaurants. They just had a deal this quarter. I forget who it was with. It was a pretty big-sized organization, as they had over 1,000 restaurant locations. So that's 1,000 locations they got just in this quarter alone from one client. But anyways, their whole strategy is they want to be the all-in-one operating system for restaurants. It's specialized specifically for restaurants. They take care of your point of service. They take care of your payment processing. They take care of your software, your front of house, back of house, your kitchen operations, your menu, your online ordering. They take care of everything for you. And basically they install the hardware, and over time they expect the successful restaurants to grow into medium to big size restaurants, and therefore to stick with Toast because they already have it embedded into their system. Therefore, they're going to see exponential growth over time. As you can tell from their IPO price, it was definitely an overvalued company back here at 53 per share. It's now down over 50% over the past 5 years. In the past 1 year even, it's down 30%. We've had a significant sell-off. Anything that's software related, they're sending to the dirt. I still believe in this company. 3-year revenue CAGR, 33%, 5 years, almost 50%. This is slowing. It's going to slow. They're taking a lot of market share. The price to earnings, it looks steep, but they're still a fast grower. They're growing like mid-20s. Revenue, EPS, free cash flow is growing like 40%. But as you can see, the next 12 months, the PE goes down to 31, which is significantly cheaper than 67. So the charts on this company are beautiful. As you can see, free cash flow per share CAGR over the past 4 years, 80%, explosive. This is the total number of locations, total number of restaurants they're servicing. They're going up 31% per year. That is explosive. They are taking over the restaurant market share. Revenues 44% per year over the past 4 years. EPS, oh, it was in the negatives. Okay, had everything but the EPS. Here we are in the negatives. They finally turned positive here, Q4 24. They were losing money. Now they're in the positives. Their operating margins are expanding. And this is the most important chart to me. This is the total number of locations. As you can tell, in 2023, they had 85,000. They have doubled that number now. From Q1 2023 to Q4 2025, they now service double the amount of customers. That is explosive. If they continue on even half of this trajectory, the valuation of this company is way more than worth it. They're going to have to be disrupted, or someone's going to have to take market share from them. And I just don't see restaurants going to other payment processors, even if they're slightly cheaper. If you were to go to a Square or a Four or any of the other payment processors, they don't provide the full service that Toast does, including Toast IQ. They use all of the data that they get from all of these restaurants. They are allowed to use that and compile it using their AI agent, Toast IQ, which provides exponentially more value per customer that they have, because they're getting more and more data on restaurants in different areas and different genres. So I just think they have the full package. They offer the best value to customers. They still make a lot of money doing what they do, providing the best service in the business. So I'm really bullish on this one. I don't believe this is as stable as a company as S&P Global or Meta. Obviously, it's nowhere near as developed, but I do love the direction of this company. I think this is one you should definitely check out. Let me know if you like this one down in the comments below. There's probably 10 more stocks out in the market today that I would like to buy, including Netflix, MasterCard. There's so many of them that are on sale right now. But these are 5 of my favorite ones. Let me know if you're buying any of these or any other stocks that you're buying down in the comments. Don't forget to subscribe on the way out, and thanks for watching, guys.